Hello and welcome to the Doc Podcast. I'm your host, Dr. Mike DeLuke, and it's my mission to help you lead a happier, healthier, and more prosperous life, both personally and professionally. Hello and welcome to this episode of the Doc Podcast. This is going to be part 3 of our 5-part financial series with the Vento family on creating generational wealth. And today I'm joined by Christine Vento Conway, whose expertise lies at the intersection of accounting, finance, commercial real estate, and tax advantage investment strategies. Christine began her career with KPMG before moving into commercial real estate finance with Meridian Capital Group. Today, she serves as Senior Vice President and External Wholesaler with Inland Securities Corporation, where she works with financial professionals and their clients to navigate sophisticated real estate investment strategies, including 1031 exchanges, Delaware Statutory Trusts, or DSTs, Qualified Opportunity Zone Funds, REITs, private real estate placements, and other institutional quality real estate investments. Real estate, as many of you may be aware, has long been considered one of the most effective tools for building long-term wealth, generating passive income, and creating financial flexibility. But I find that when I speak to people about real estate, it's often intimidating. Many people assume that investing in real estate means finding tenants, fixing toilets, and managing properties. But in reality, there are numerous ways that you can gain exposure to real estate, each with its own risk profile, tax implications, and investment objectives. And that's why in today's conversation, we're going to provide an overview of the real estate investing landscape and explore many of the different ways investors can participate, from direct ownership to professionally managed investment vehicles. We're going to discuss how these strategies work, who they may be appropriate for, and how they can complement a broader wealth building plan. We're also going to spend some time discussing tax-efficient strategies such as 1031 exchanges, Delaware Statutory Trusts, and Qualified Opportunity Zone Funds while addressing some of the common misconceptions surrounding these treatment approaches. So whether you're someone who's just curious about real estate investing or you're looking to better understand the strategies available to you as your income and your wealth grow, I am confident you are going to really enjoy today's conversation and gain a ton of valuable information out of my discussion with Christine. As always, the information that we discuss during this series and in this episode is intended for educational purposes only and should not be considered individualized financial, investment, legal, or tax advice. Before making any financial decisions, please consult your own professional advisors. You can also find additional disclosures at the end of this episode. I do want to let you know that we have a few spots remaining for the 2-person course that I'm running with my friend and colleague, Dr. Daniel Camacho, this November 13th and 14th in Fort Lauderdale, Florida. It is going to be an amazing event, and it includes 41 hours of ADA CERP recognized CE, including observation of live patient care. To register, go to earlyorthotreatment.com or click on the link in the show notes. I promise this course is going to transform how you approach early airway-focused treatment and allow you to change more lives than you ever imagined possible. So without further ado, let's get on to today's episode with Christine Vento Conway. Enjoy the show, everybody. Welcome back to the Doc Podcast, Christine.
Thanks so much for having me, Mike.
Looking forward to this conversation. I appreciate you coming back on. Really having a lot of fun doing this. So just to refresh the audience's memory, we started out with a joint episode with your entire family, and I'll put links to all these episodes in the show notes as well. And then had one with your dad alone, which we had a great overview of the macro picture of finance and investing, taxes, and kind of gave a nice overview of the book, The Generational Wealth Code, which we'll talk more about in detail on the real estate side today with you. And so we're starting more individual episodes of the siblings now. So we're starting off with you in the real estate side. So if you don't mind, just remind the audience of your overall job title description and what you do on a daily basis before we get diving into some of the content.
Sure, absolutely. And I'm really happy to be doing this with you again today, Mike, as well. Just as a reminder, for those of you who might have missed the podcast that we recorded with the rest of my family, I am a senior vice president at Inland Securities, which is a firm separate from the firm that my family owns. Actually, my brother, sister, and father are technically clients of mine. And what we do at Inland is we work with financial advisors like my family, and we offer 1031 exchange solutions and other various real estate strategies to investors through their financial advisors. A huge part of my role at the company is really educating clients, educating advisors on how real estate works, how 1031 exchanges work, and guiding investors who are looking to use a 1031 exchange through the process to make sure that all the steps of the exchange are followed correctly and they end up in the passive investment vehicle that they're looking to invest in. I'm also
Great.
a CPA, although I'll add the caveat, and Mike, I think you'll probably mention this too, but I'm not authorized to provide tax advice, but it does provide a little bit of a unique perspective in being able to talk about this subject.
I think that's huge too, that you have that CPA background. It really is nice because it gives you that perspective. It really does, where you can, because as we're going to talk about today, a lot of these decisions that people will make when it comes to real estate and investing in real estate as an asset class boil down to taxes, really. And we're going to probably mention the word tax, I don't know how many times, but a lot, because a lot of the strategies that you could take advantage of have been written into the tax law, and especially with the recent One Big Beautiful Bill Act, to be very favorable to the real estate investment side of things. So we'll dive into that as well. But you having that knowledge, I think, is huge. Even though you're not offering direct CPA-related tax advice, you still can speak to the law on that and know it and understand it versus just kind of parroting it back and saying like, oh, this is what the book says. But you actually have that perspective. So that is awesome. What do you do in your typical day, so to speak, in terms of how do you work with clients? What does that look like? If somebody's thinking about working with you or someone in this type of arena, I mean, are you on the phone with them? Are you the one that finds these deals? Are you kind of guiding them through all of this, all the above?
Mix of all of what you just said, Mike, and then a little bit more that I can add to that. We focus on working with advisors and educating advisors on the benefits of offering 1031 exchange solutions to their clients. The 1031 exchange code has been in our tax code for over 100 years. And in the most simple explanation, it says that if you or a client are selling an investment or business use property, and you use the proceeds to acquire a replacement investment or business use property, and you do so within a specific time frame following specific guidelines, then it allows you to defer 100% of the capital gains taxes that you would have had to pay on the sale of that relinquished property. Pre-2004, the only way to do that is if you were selling a property you actively managed and used the proceeds to acquire another property you had to continue to actively manage yourself, unless you went into a tenant in common, a TIC structure, which is not a true passive investment form. So Inland actually was one of the companies who spent years petitioning the government to allow a passive investment vehicle to be used as a 1031 exchange replacement. And in 2004, the IRS approved the Delaware Statutory Trust, the DST. And so my primary role is to educate advisors on how 1031 exchanges work with DSTs so that they can look at their book of clients and recognize where there might be an opportunity to offer this kind of strategy to clients, typically ones who are at a point in their lives where they're not looking to continue to actively manage their own real estate anymore, but are not wanting to pay. Usually, I'm just throwing rough numbers out there, but I'm in the New Jersey area, so usually investors end up paying roughly 30 to 40% in capital gains taxes when they sell their properties and do not do an exchange. Mm-hmm. And so it is wildly beneficial to use this strategy and take advantage of this. And what we do at Inland and what my primary role is working with lots and lots of advisors. So helping them educate their clients, having phone calls, Zoom meetings, in-person meetings. And I do lots of live events. I do lunch and learns at steakhouses all over the area. And we encourage advisors to bring not just their clients, but also bring real estate attorneys, real estate agents, and CPAs so that anybody who is influencing the client can get on the same page.
Got it. Okay. And so really I guess to back up a step on that. So when people hear this, and I just want to, I'll speak to this personally. I'm an open book on this stuff, and I've worked with Inland. I have nothing to hide on that. And you guys aren't paying me to say that or to promote this. There's no relationship there. I've been a customer of your families, and I just love the products you offer. And we'll talk a little bit more about that and some of the challenges. And that's not all perfect either. And I can speak to that as a customer as well. But it's a great asset class. But when people hear this, a lot of times people hear real estate and they're like, yeah, I know real estate's great and whatever, but I don't want to be owning duplexes, and I don't want to be getting calls from tenants, and I don't want the headache that goes along with that. And while that is certainly one way you can invest in real estate, just paint the picture a little bit, if you would, from a macro standpoint before we get a little more granular on it, how this is different from that, what you're talking about here.
Sure, absolutely. So you might have heard it said in the past that when you're evaluating an investment vehicle, you're really looking for 4 key features. And most investment vehicles will offer maybe 2 of these features. If you're lucky, 3. Real estate's the only one that offers all 4 of these features that I'm about to mention. Number 1, we'll say it again, Mike, tax benefits. Number 2, the ability to take advantage of the power of leverage. Number 3 would be income, and number 4, appreciation potential. So again, most investment vehicles out there might offer 2 of these features. If you're lucky, they offer 3. Real estate's one of the only investments out there that has the ability to possibly offer all 4 of those kinds of benefits. And so I can spend as long or as little as you'd like going on about the tax benefits, the power of leverage, the ability to take advantage of your tenants paying your mortgage every month, and then also the more income that you make off that property, the typically higher that property is going to then appreciate in value. Real estate's one of the only strategies out there that allows for phantom deductions against your income in the form of depreciation. And it's one of the only strategies out there where when you do sell the investment vehicle, you have a huge opportunity to defer significant amounts in capital gains taxes through, like I mentioned earlier, the 1031 exchange. And the 4th feature, I know I'm going a little out of order in the order in which I mentioned them, Mike, but that 4th feature, which is the power of leverage, being able to have a lender and you as an investor borrow against an investment is not something that's offered in most investment vehicles. It allows you to buy more properties with the same amount of cash that you have on hand and essentially have huge potential to earn much higher returns than you would if you weren't able to use leverage to buy that property. So there's really significant benefits, just keeping it super high level, like you said, Mike, on investing in real estate in general. But to get into more granular detail on the differences between owning a duplex and owning an investment vehicle like what we offer at Inland, when Inland buys properties, we do all the due diligence. We're typically looking in really core markets, typically newly constructed, highly amenitized, generally properties that are already generating a nice, healthy income stream. Now, that's not to say there's not risk involved with our strategies as well, but I would definitely argue that there's a lot less risk involved in investing with us than there would be in buying a property on your own. If you just put it in perspective, Mike, if you buy a property for $500,000 and you buy a duplex with that $500,000, you have 2 tenants. But you could also take that $500,000 and invest it in a program with Inland and have access to, for example, a 300-unit multifamily property or, a 7-property self-storage portfolio that consists of 700 units, right? In that scenario, if we go back to the $500,000 buying you a duplex, one tenant moves out, you just lost 50% of your income.
Yep.
You invest in a 300-unit multifamily property with Inland, one tenant moves out, nobody blinks an eye. So it's a lot less risky to be able to have access to institutional quality properties. And to add to that, if you invest your $500,000 into that one duplex and it's located in Brooklyn, let's just say, if that's your only real estate holding, you have a really high concentration in that one asset, in that one location, in that one sector. If you invest in programs with Inland, you can take that $500,000 and invest it through various strategies so that you're well diversified both geographically and by asset class.
Yeah, I'll speak to this personally just to paint a little color. I've owned all of those types of asset classes, meaning everything you mentioned, from a duplex, although ours was a mixed use unit where my office building was, where I had 2 tenants in addition to my practice. So I've been there. When one moves out, that rent goes away quickly. It doesn't take long. It's just that 1 month, all of a sudden that rent check's not coming in. I've owned storage units. I have assets in that class, and luxury high-end apartment buildings with another group. And then we're going to talk more about DSTs and 1031 exchanges, as well as qualified opportunity zones through you and through your dad, and Inland, and a couple other companies, Cantor and a few others that we've worked with over time to execute the DSTs. So I can repeat everything you just said, and it's correct. It really, from the end user standpoint, right, from the client standpoint, it's a very different feel. And I think there's a place for all of those assets, right, if you can afford it, to have some in different places in different ways, and that's up to each. Again, this is not individual advice, just speaking personally. That being said, the most passive of anything is really the types of exchanges and opportunities that you're speaking of. They really are passive. And people will get caught up and say, yeah, but that company's making money, or everyone's making money on the fees. Well, yeah, of course. There's a trade-off. You're going to pay, your lawyer's making money for advice, your accountant's making money for advice, your financial advisor is making money for advice, your orthodontist is making money for the procedure they perform, right? You guys are providing a service, and of course there's going to have to be a fee for that. As long as the fees are reasonable and you still return a great net on it, to me, is what really matters. And as you said, the diversification of the asset class. Some of these funds, one we did when we sold the property, we ended up splitting it into 3 different DSTs, and we'll come back to this in a little more detail, just trying to give the audience a feel for some of what's possible. And we sold a piece of an asset, like a rental property, essentially, that we were able to, because of the sale of it, put it into 3 different DSTs, which again, now you're leveraging it over. And one had a 3 locations, 2 in Florida, 1 in, I think, Indiana. And those were in the healthcare sector. One was in college housing at a university in South Carolina. So it's like you can, if 2 students move out of this, 250 unit college housing place, you don't feel the same effect. Now, that being said, I will tell people one of the ones I've invested in, it's in an area that area geographically has not done as well recently. It's in an urban area that's had a lot of competition move in, and they haven't kept up with the population growth. So I just got notification a couple months ago that they're cutting the distribution on that. It's still positive, it's cash flowing, but it does go down. So like you said, it's not like this is a magic wand. That being said, if that was my only property, right, and that was the only thing I had, you're much more vulnerable and susceptible to that. And just want to touch as well on the tax side, when you were referencing getting taxed on the sale of an asset. You sell a stock, let's say you have a pre-tax, if it's a qualified fund, you're paying income tax on that. And if you sell a post-tax investment, you're paying capital gains. And as you said, based on the state you're on, that number gets pretty big. So when we look at getting into the tax side and the 1031 exchange side, get a little more granular on it, how does that change? So let's just take, for example, I sell a property that I own as, my office building. Let's just take that, right? I sell it because I've done this too. You sell your office building, whether you are retiring or you transition to a younger doc, and I could take that amount of money and I could keep it. And I would pay tax. I would pay capital gain on the gain. It gets a little technical based on what your cost basis is, based on depreciation and the gain on that property, but you're going to pay tax on that gain. So let's just say the gain was $500,000, just to keep numbers round, right? Talk me through what that looks like for that $500,000, which I would be paying, if you're in a state tax state as well, you could be paying, like you said, 30+% on that. What is the difference if I were to do something like a 1031 exchange? And again, we can get to the DST side in a moment, but just looking at it from that sort of alternative approach.
As far as what the tax consequences typically look like, Mike?
Yeah, how would that look? So I guess for the $500,000, if I was going to owe, that was my gain, and I was going to lose, a third of that. I'm going to lose, let's round the number, say $150,000 or whatever of that I lose, right? So I'm left with $350,000 in my pocket, and I just gave $150,000 to the government. Again, just kind of ballparking. How would that be different with something like a 1031 exchange?
Hey, everybody. Quick question. How many kids are you seeing who are mouth breathing, snoring, not sleeping well, maybe struggling with focus or behavior in school? You know something's off, but we're never taught how to treat these patients early. So we wait. Wait for more teeth, wait for maturity, wait for the permanent dentition. Meanwhile, that child keeps suffering. Well, it's time to change that paradigm, which is why I've partnered with Dr. Daniel Camacho to launch the Early Orthodontic Treatment Comprehensive, a hands-on, 2-day immersive experience in Fort Lauderdale, Florida, this November 13th and 14th. You'll learn to identify these patients early, read CBCT images, coordinate with medical and OMT colleagues, and deliver proactive dentofacial orthopedic treatment. You'll study real cases, then watch it done live on actual patients. So you'll return home with the confidence needed to implement it in your practice on day one. And the support doesn't stop there. The registration fee includes my full 26-hour online course, a live remote case review in spring 2027, and a full year of discounted coaching. So click the link in the show notes and grab your spot before it's sold out. We'll see you in Fort Lauderdale.
You would keep the full 500,000. So that's really the major benefit, right? So I think it's important to kind of, and you tell me, I don't want to get too nuanced here, so just stop me if I'm getting too granular, but let's take it back a notch and just kind of look at the scenario you just described. Let's say when you bought your building, you had originally bought it for $200,000. Something really unique to real estate, like I mentioned earlier, is it allows for a phantom deduction called depreciation to deduct against the income that you're earning on that property each year. Depreciation is a phantom deduction that the IRS allows, which essentially says that they recognize, even though we all know over time, generally speaking, real estate appreciates in value, the physical assets themselves deteriorate. And they recognize that and say, because of that, you can depreciate against your income just on your tax return each year to essentially allow you to pay less in taxes than you would have on the income that you're receiving from that property every year. So let's just say, Mike, you bought that property 20 years ago, and fast forward 20 years later to today, you've depreciated it, and now your adjusted cost basis, which, again, just for your listeners, your adjusted cost basis is equal to your original purchase price plus any capital improvements you've made to that property, less depreciation. So let's just say now 20 years later, you've depreciated that property to $100,000 and you're selling it for $600,000, and we'll say that's where you've gotten your $500,000 gain from.
Perfect. Yep. Great. Thank you.
If you've depreciated that property $100,000 because you were saying, okay, you bought it for $200,000, now it's depreciated down to $100,000, so the difference is another $100,000. That depreciation is now taxed at essentially a higher rate when the property is sold if you do not do an exchange. It's called depreciation recapture tax. Yes, the IRS allows you this great benefit while you own the property, but if at any point you sell the property and do not do an exchange, they now want to tax you for all the benefits that they've provided you at that higher rate. In addition to that, you're going to have a federal tax, you're going to have a state tax depending on what state you live in and what your tax bracket is. And most investors also get subject to a Medicare tax, which is typically about 3.8%. So all in all, most investors do end up paying roughly at least a third of their sales proceeds to the government in taxes when they do not do an exchange. By the way, this is why everybody wants to listen to this conversation that we're having about 1031 exchanges, because this is what you're saving on. You're saving roughly 33%. Again, typically speaking, it varies depending on your tax bracket and the state you live in. Typically, you're saving roughly 33% in capital gains taxes if you do an exchange. Because if you do a 1031 exchange, yes, there's lots of rules that need to be followed, which, Mike, we can definitely go through a lot of those rules on this on this conversation today, but if you do a 1031 exchange correctly, you would not have to pay a single dollar or dime in taxes to the government.
Mm-hmm. Yeah, thank you for explaining that and going through some numbers a little more specifically to help paint that picture. And I do want to say, too, I really want to make the point for people listening out there, and we have docs and laypersons and all different types of people. It's a really wide range who listens to this show. Talk to your advisor and share this with your advisor. Send them this episode because it's possible they don't know about everything Christine is talking about. And it's not a slight to them or that they aren't a good advisor. It just might mean that they just haven't had experience in this, or they're not aware of they heard of it, but maybe don't understand it in depth. And it did just change recently. A lot of these things, there's constant changes in this, which is again why it's awesome you guys put out the new book, because a lot has been revised even in the past year. So talk a little bit about what that process looks like while we just maybe continue on this conversation of the sort of hypothetical $500,000 gain from selling your office building or a second real estate property you might own. And I just want to clarify, correct me if I'm wrong, this is not on your personal residence, right? This is an investment property.
Absolutely, Mike. Yep, that's rule number one of doing a 1031 exchange. 1031 exchanges only apply to what's referred to as like-kind real estate. Like-kind is a very misconstrued term in the 1031 exchange language. It does not mean that if Mike is selling a duplex that he has to now invest in multifamily. It simply means that both properties in the exchange need to be held for investment or business use purposes. So it's essentially excluding primary homes and vacation homes as 1031 exchange eligible real estate. I will add a minor caveat that if you do own a vacation home or a primary home and you have the funds to move out of that home without selling it, and you rent it out for 2 years, after 2 years, it'll generally then be able to convert to 1031 exchange eligible real estate so that when you do sell, you can then do a 1031 exchange with that now investment use property. And I do, just before we get into the process here, Mike, I do want to heavily emphasize the point you just made about the fact that a lot of CPAs and advisors are extremely unfamiliar, not just with how 1031 exchanges work, but for sure with DSTs, which we'll talk more about as well. It is a 1031 exchange most people are kind of familiar with, but DSTs as a passive investment vehicle that could be used for 1031 exchange replacements is something that very few CPAs and advisors are aware exist. Like I mentioned earlier, I do seminars usually on a weekly basis, have 20 to 50 people attending those seminars, and we almost always have at least a handful of CPAs in the room. And you always get at least a couple of them who say, this was so useful, this is the first time I'm even hearing about this strategy. So don't assume your CPA or your advisor know about this. Bring it to their attention, and then bring us in, and we're happy to explain how it works.
Awesome. Thank you for clarifying that as well, or emphasizing that as well. So let's go with that $500,000. We sell that asset, and we want to do a like-kind exchange under a 1031 exchange. And everyone listening and watching, stay tuned. We'll come back to the DST. It's something I know is kind of interwoven into the 1031 exchange lexicon, but Christine's going to explain a little more detail how they relate. But just kind of speaking now from the 1031 exchange tax law standpoint, how does that play out from that point at which you sell? And I just want to add, make sure you're thinking about this before you sell. So you don't want to wait until you sell to start to figure out if you're going to do a 1031 exchange. And I could go into that, but Christine's the expert, so I'll let her explain that a little bit more. I can speak to it personally, but I didn't. Thankfully, I had your dad there to guide me through and advise me what to do. And you know what? I'm going to say one more thing. I said it on your dad's episode. It's really important. That's why I love doing these shows and putting this content out, because you, the end user, the owner of this property, you have responsibility. And like Christine and I were just saying, yes, you can pass this along to your CPA, your tax advisor. At the same time, you have to know what questions to ask. And if I just called your dad up one day and was like, hey, or waited until I met with him or your brother to do the taxes, it was like, oh yeah, by the way, we just sold this property, and they're like, whoa, you're going to have a huge tax event, right? it's too late. It's too late. We're going to talk about the windows when you have to identify and the steps with a qualified intermediary and all these things we're going to go into momentarily. So you have to know what questions to ask and be educated. And the book does a great job in chapter 11 going through this as well, in addition to the podcasts. But I can't overstate that, because I find so many times people just want their CPA just to tell them everything. But it's not the way it works. It's like a coach and a player, right? The player has the coach there to guide them, but the player also has a responsibility to do a lot of work in the background to be able to be coachable.
Couldn't agree more, Mike. The absolute worst phone calls we receive is, hey, my client sold their property yesterday, and we asked them where the money is. And I'll explain to the audience why in a moment, but they say, oh, it's in my bank account or my attorney has it. That's the worst call we can receive, because that simply means that the advisor and the clients were not communicating early enough in the process. Mm-hmm. And now the client's in a position where they've missed their opportunity to do an exchange. At least give yourself the option. If you decide it's not the path you want to take, there's still ways to take advantage of keeping your options open a little bit longer in case you change your mind and don't want to pay all those taxes that we're talking about. So like Mike said, involve your CPA, involve your advisor as early on as possible. There are strategies that can help with the sale of properties if you're not looking to pay significant amounts in taxes. Mm-hmm. So going back, Mike, to your question about how this process works, mm-hmm. I think it's important to understand why first. So the IRS, like I said, for over 100 years, they've offered this 1031 exchange benefit in our tax code. And the reason for that is because they recognize that if you're selling an investment property and buying another investment property nearly simultaneously, then that should not trigger a taxable event for you. It also incentivizes investors to sell who might not otherwise would have sold. And that provides lots of tax benefits to the government. I will tell you, every 4 years, the 1031 exchange code gets put on the drawing board as something maybe they should eliminate when we have, new people coming into office. And every year we petition the government and educate them on why it's beneficial across both lines. It gets lots of bipartisan support each time. And clearly it wins time and time again because it's been in our code for as long as it has. And the reason for that is because
mostly all the politicians are using it. Most of the politicians are using it as well, right?
Right. Well, in addition to that, Mike, it's also pension funds, retirement funds, charity funds. Yeah. They own real estate. So you're taking money out of everybody's pockets if you get rid of the 1031 exchange benefit. This is the worst thing I like to hear is that this is a loophole for the rich. That is the furthest thing from the truth. It is really served for lots of middle-class Americans who own a $500,000 property. I mean, how many people do we know who inherited a brownstone in Brooklyn 40 years ago, and now it's worth a couple $1 million? So it serves lots of individuals all across the country. It serves various types of organizations. Like I said, pension funds, charities, everything. So once Congress is made aware of the tax dollars that they'll lose out on as well, that's why they don't get rid of it. And what I mean by that is, what we say is owners maintain, buyers improve. So, Mike, if you own a property for 40, 50 years, usually you're not doing much to make improvements to that property. If it's generating you a nice, healthy monthly income stream, you're going to leave it as is. But when you sell that property and someone else comes in and buys that property from you, you and them are hiring real estate attorney, real estate agent, title agent. Usually someone who's coming in to buy a property is then going to be making improvements to that property. They're hiring contractors, engineers, so on and so on and so forth. So you're employing a lot of people every time a 1031 exchange gets done, which brings a lot more tax revenue to the government than would be if they got rid of the 1031 exchange and taxed individuals every time they sold.
And if I take it a step further, wouldn't it also go to the fact that then you can charge more rent, or especially if you're doing this with macro and bigger, 400 unit places, you bump the rent up 5-10%. Now that's more income to that company that the government can then tax as well. So, I mean, they get it on the back end too.
Exactly. And the reality is, Mike, without going down a rabbit hole too early on, I know we'll talk about the step up in cost basis, but if you owned a property and the 1031 exchange wasn't an option for you, you're way more likely to just hold that property until you pass away so that your heirs will get a step up in cost basis and have little to no capital gains taxes to pay on the real estate than you would be to sell that property and have to pay taxes. So huge benefits that the IRS allows. And essentially the way it works is you sell your investment property and you buy a replacement investment property, you get to defer all the taxes. Now, there are specific rules that need to be followed, like we already talked about. It's only investment or I should say business use properties as well. So if you own your own practice and the business that you operate the real estate or the office that you operate your practice out of, then once you eventually sell your business, if you also sell the real estate with the business, then that portion could be bifurcated and 1031 exchanged into an income producing investment like a DST.
And ideally, and we talked about this with your dad a little bit too, ideally, again, not giving direct advice, just ideally, you should have that real estate in a separate LLC, not owned by your PC, just from a strict liability standpoint, let alone the tax side. So,
yes, yes, exactly. So, Mike, I'll kind of go through a little bit of what some of these rules are now.
Perfect. Yeah.
Okay. So, first and foremost, from the day a property sells, 2 clocks will start ticking. The first one says you have 180 days, including weekends and holidays, to acquire a replacement property. And within that time frame, you only have 45 days to identify which property or properties you want to use for replacement. So just rewinding a moment, before the property even sells, and we'll get back to these 2 deadlines in a moment, but before the property even sells, and Mike, this is why I said earlier that the worst calls I get is someone who calls me and says, hey, my client sold their property yesterday, can they do an exchange? And I have to say, unfortunately, unless the money is with a third party qualified intermediary, you cannot do an exchange. A third-party qualified intermediary is a disinterested individual who is not involved in the exchange in any other capacity other than as the qualified intermediary. I'll use the abbreviation sometimes as QI. They're someone who really should be lined up while you're under contract. Usually roughly 30 days before the property sells is a good time to start engaging a QI and interviewing and deciding who you want to work with. Because they are such an integral part of this process. When your property sells, if the buyer writes the check to you, you already have disqualified yourself from doing an exchange. On the day the property sells, your buyer will actually write the check or wire the money directly to this qualified intermediary who you have hired. And that qualified intermediary will hold the proceeds in an escrow account throughout the entire exchange process.
And mine was an attorney. Actually got the name from your dad. Is it usually an attorney, Christine?
It should be. If I'm recommending someone, it's going to be someone who's an attorney by trade. They are backed by a larger bank and a huge corporation behind them. Technically, though, speaking, Mike, you could be a QI as long as you're not involved in an exchange in any other capacity. You could be a QI. So you could ask your cousin who lives down the street from you to be your qualified intermediary. Absolutely anybody could be a QI. It's crazy in the world in which we live in. For those of you who are familiar with the securities industry, you'll know that we are very heavily regulated, audited, et cetera, et cetera. QIs are unregulated, unaudited on everything.
I didn't know that. That's crazy. I had
It's crazy.
idea.
Yeah.
And I would just add to that too, make sure, please tell your real estate attorney that you're doing this because they have to prepare certain paperwork. And if you wait last minute, when it's too late. So you've got to let your real estate attorney that you're working with as the seller know this is what I'm looking to do, because it changes how they draft up the closing documents.
Correct. Yes. There's two things that I tell investors that if they want to keep their options open for doing an exchange, there's only two things that need to get done before the property sells. One of them is the hiring a qualified intermediary, and the other one is what Mike just mentioned, which is make sure your attorney puts the proper wording in the sales contract that you may do a 1031 exchange, because that's what sets the sale up as an exchange before your property sells.
Okay, thank you.
Once the property sells and the money goes to the QI, that's when those two clocks start ticking that I just mentioned. The 180-day clock, where you have 180 days to reinvest and buy a replacement property. Or if you decide to use a strategy with Inland, you would invest with Inland by that 180th day. And then the first deadline in between the day of the sale and the 180-day deadline is the 45-day window. So let's just say you're closing July 31st. You'll then have 45 days after July 31st to put in writing to your qualified intermediary which property or properties you intend on acquiring. I always tell investors, and QIs, my QIs that I work with hate when I say this, but you can drive your qualified intermediary crazy, change your mind 100 times during that 45-day window. They probably won't ever want to work with you again, but you can technically do that. Once midnight strikes on day 45, though, whatever you have written down are the only properties you're going to allow to be to actually acquire. So if you want to identify one property, call it 123 Main Street down the block from where you live, and that's the only property you identify, well, if day 46 and 47 roll around and 123 Main Street has environmental issues or engineering issues, or you can't get the financing you thought you'd be able to get, and you didn't identify anything else during that 45-day period, you're going to be stuck paying significant amounts in taxes like we just talked about.
And not be able to do the
really
exchange.
strongly, correct, exactly. And probably have to wait the full 180 days to get your money back from the QI. So I really, really urge any investor and advisor to talk to your clients. But for those investors who are listening, if you own your own property and you're saying to yourself, I'm too young to go passive, and I like having hands-on control and being able to see, feel, and touch and manage my real estate myself, great, do it. But if you are doing a 1031 exchange, it's no harm to you at all to at least just identify one of our strategies as a backup option within that 45-day window. It doesn't obligate you to move forward with it, but it provides a safety net from day 46 to day 180 in case your first choice doesn't work out for you.
Great.
So once that the properties are identified, what I would say is, by the way, even easier are clients who know up front that they do want to be passive, because we can have everything lined up ahead of time so that by the time your property sells, the money can go to the qualified intermediary, and a week or so later, we can have the money sent back to us at Inland. And you don't have to worry about either of those deadlines that we just talked about, the 45-day or the 180-day, because you're doing it all within a week or so, and we're doing all the heavy lifting for you. And to add to that, you don't have to worry about any hiccups in your income stream if you are somewhat or even heavily dependent on the income that you're receiving from your current investment property. You don't have to wait 45 to 180 days to start receiving that income again. I'll talk about, like Mike said, I'll talk a little bit about how the DST specifically works, but we already own the properties. So as soon as you make your investment, the monthly distributions start kicking out.
So then you have the 180 days to complete. Let's say that's done. And now what does this look like?
Yeah, so let's just kind of talk about one last piece of the puzzle, Mike, which is comparing what you're buying to what you sold.
Please.
So what I like to say is I'm going to assume that everyone listening is completely tax averse and does not want to pay a single dollar or dime in taxes to the government. The reason I say that is because there's always the option to do partial 1031 exchanges where let's just, and I'm going to use rounder numbers here, Mike, you're selling for $1 million. The full $1 million sale is a capital gain. But you think you might need $300,000 of liquidity at some point in the next couple of years. You could always take that $300,000, pocket it, pay taxes on it, and then defer the remaining $700,000. However, assuming you want a 100% tax deferred exchange, you would need to replace the full $1 million worth of real estate that you sold. And that's a really important distinction because let's just say, Mike, you're selling a duplex for $1 million. And at the time of the sale, you have a $300,000 mortgage on it. Imagine we're at the closing table for a moment. It's you, the buyer, your attorney, your bank, and anyone else, the title agent, etc., anyone else involved. Your qualified intermediary. The buyer writes you a check for $1 million. $300,000 goes to the bank to pay off the loan. $700,000 goes to your qualified intermediary in an escrow account. That $700,000 needs to still buy you $1 million worth of real estate. If you're buying another property through a 1031 exchange on your own, you can come out of pocket the $300,000 of cash to make up the difference. You can go to the bank and get another loan for $300,000 to make up the difference. If you don't replace it, you can pay taxes on that $300,000 that you don't replace. But if you're using a DST with Inland, you won't have to worry about either of those three scenarios. You'll simply need to go into a DST program, an offering at Inland that has a loan to value that meets or exceeds the loan to value on the property you had at the time you sold, which in this case, a $300,000 mortgage on $1 million sale is a 30% loan to value. You'll simply go into one of our programs that has a loan to value that is 30% or higher. And that would satisfy.
That's a huge distinction for everybody out there, by the way. I can't overstate how big that is. It's a game changer because it ultimately, I mean, like I said, you'd have to go assume that debt yourself, which comes with time and fees and all the other associated personal costs, and then paying down that debt as well. Or you would have to take the hit and not receive the full tax deferred treatment for the sale, or you would have to come up with cash and so outlay $300,000. And so what you're saying, just to underscore that for everybody out there, and maybe go back and just replay that part so you don't have to restate it all. People listening can go replay it. But what you're saying, if I'm not mistaken, is by using certain portfolio options with Inland, they could structure the exchange, the new property could be structured with a similar debt to asset ratio that would fulfill the requirements and still allow them to not have to fund that gap of $300,000, correct?
Correct. And to be clear, Mike, that loan, that Inland, because the way the DSTs are structured is Inland will go out and buy properties on our own balance sheet first. We may buy a property without debt, but we do finance a good portion of our properties because of investors, like the example we're using now. If you sell a property with debt and you're looking for a 100% tax deferred exchange, you need the debt on the DST to replace your debt on your property that you sold.
Yeah.
And so we offer that, and it does replace the debt for tax purposes, but it is non-recourse to investors, meaning you're not personally liable for that loan. There are no, those of you familiar with the financial services world, there's no capital call, so to speak, on these programs. If we ever default on a loan, banks are not coming knocking on investors' door for repayment. It's Inland's responsibility.
All right, great. Thank you. So now you've got those properties identified and you close. What does it look like from here? How much work goes in for me, so to speak, if I'm the one doing the sale, right? I've identified the qualified intermediary, cuts the check to Inland. The properties are funded. What does it look like at this point?
Sure. So the way the DST process works is really think of it as three main phases, and these should sound like the exact same phases that you have in your own investment or business properties. Phase one, we source the properties. We look for properties that are typically going to be in strong markets with strong tenants, already generating a nice, solid, healthy monthly income stream. Once those properties are sourced, we do the due diligence. We, at my company, we've done lots and lots of different strategies, pretty much everything you can think of. Historically, we've done industrial, retail, office, hospitality. Right now, we're very focused in the multifamily, self-storage, student housing, and senior living sectors. And the reason for that is because if you look at the data, it shows that those sectors have historically been a lot less volatile and much more recession resilient and a lot less correlated to the markets. Because if you think of the nature of those sectors, multifamily, self-storage, student housing, and senior living, they're much more tied to life events and demographic trends versus office and retail and hotels, which are much more tied to how the economy is performing. And so those are the kinds of programs that you'll see. And again, in a few years from now, real estate market can change a bit, but that's what you're going to see mainly from us, at least in the near future. Once those properties are sourced, we underwrite them, we do our due diligence. Like I said before, when we go to acquire the properties that meet all of our standards, we may or may not finance them. If we're going to finance them, they're generally not going to be more than about a 50% loan to value, give or take, which, yes, there is more risk involved with debt in general, but a 50% loan to value is still relatively lower risk than obviously if you're comparing it to getting a 75, 80% loan on a property. After we acquire those, or I should say, once we acquire those properties, we then allow investors to come in and subscribe to the program. I think something that's really key consideration here, because we did briefly mention this earlier, is the benefit of being able to diversify. We separate our programs by asset class, not necessarily by geographical location. We may have a 7-property self-storage portfolio across 3 states. We may, and I'm just throwing out types of examples, Mike, of offerings that we could have open. We may have a multifamily property in New York. We may have a student housing portfolio of 3 student housing properties in 3 separate states. We may have 2 properties senior living portfolio in 2 separate states. So we separate them by sector, but not by location. And the benefit is, if you love one sector, depending what we have available, when your property sells and your money is ready to be invested, you may be able to say, hey, Christine, I love multifamily, or I love self-storage. I'm going to invest my full $1 million, or I should say in this example, it's really $700,000 of equity into one of those programs. And you would still get the geographical diversification. But you can also say, hey, I want a little bit of all of what you have. And I want to split my $700,000 4 different ways. And now you're not just getting the geographical diversification, you're also getting asset class diversification. And again, going back to the point we made earlier, Mike, if that's your only real estate holding, well, you just went from a really heavy concentration in that single asset, in that single location, in that single sector, to now a nice, well-diversified real estate portfolio.
Yeah, and that's such an advantage, too. I'm glad you mentioned that, because that's what I elected to do. And when we were looking at different options, I loved the fact it's like, okay, I could have across different asset classes, as well as in different geographic areas and regions. And it's really nice. And just speaking personally as someone who we pay for my daughter to be in a student housing unit at UF, and then also have storage in between when she moves from one place to the other. It's a much nicer feeling when you're paying that money, when now it's not the ones I own, the ones at different colleges, but it's like, it does sting a little less when it's like, oh, but on the other end, I'm actually making money every month to cover the cost of what I'm paying that from the student housing that we own a part of in another state. And the storage units, we use storage. It's like, great. Yeah, but this is good because we get quarterly disbursements from that. So just the psychology of it, I'll just throw that in from a personal standpoint. It's kind of nice when you go to do these things and it's like, my gosh, they're charging a lot for student housing. It's like, yeah, but actually I'm making a lot from that. So it does soften the blow a little bit.
I would love to know if what you're making on that student housing investment is fully covering what you're paying for your daughter's room there.
It's actually almost 1-to-1. It's crazy.
Oh, that's fantastic.
Yeah.
Good for you.
It literally is almost 1-to-1. It's pretty cool. So
that's great.
Yep. So and it's passive. Like, I mean, once you make that investment, I mean, it literally is passive. It is work initially, and I think, Christine, correct me if I'm wrong, but sometimes I think a lot of people hear what we've just spent the last 45, 50 minutes talking about, and sometimes it's just overwhelming. People might want to kind of shut down, like, oh my God, now I got to identify these properties, and I've got to know what to do and work with someone like yourself, or my CPA needs to work with someone like yourself, and I have to research this, and I'm not familiar with this, and it's scary and it's different. And like qualified intermediary, how do I put all these pieces together? I think that's the important point, is there are people there that can guide you through this. I didn't know all this before your dad started talking to me about it. And then once he mentioned it, I went and read about it and learned more about it, which is, again, where you guys booked awesome for that. Listen to the podcast, listen to it a couple of times, share it with your advisors. And then it's not rocket science. Once I did the first one, the other ones have all just been like autopilot. It's just a matter of just identifying and choosing the properties you want. That's the hardest part, is just picking, because sometimes you've got some really good options and it's like, do I want to do this? And, it is a little bit, I guess it'd be like analogous to picking certain stocks, right? You have a certain amount of money, you want to put it into certain parts of the market, and it's like, yeah, but which one's going to do better in the end? And they all have projections, and I can speak to that part as well. You guys do a great job giving layouts of the property, summary sheets. It's kind of like a pro forma, right? That you would put out, that we get, that you can look through, and has the loan to value ratio and how much debt it's carrying, if any, and how that will impact your investment, anticipated rate of return. Obviously, it's just for guidance, but it's been pretty accurate for the most part, I'd say, within 0.5% of what they estimated. Approximate time that it's in there, and that's kind of the next spot I want to get to. Is so now we make this investment, it's done. I'm getting monthly, literally, deposits just into your account. How is that money treated from a tax standpoint? So let's just hypothetically say it's $2,000, right? It comes in a month from this one investment. How is that treated for tax purposes at the end of the year? And then what happens to your tax situation on that property going forward? Since you didn't pay the taxes in the year you sold and rolled it into this other property, what does it look like going forward?
Sure. And let's just rewind a moment, Mike, because when we started talking about the DSTs, I mentioned there's 3 main phases. Mm-hmm. Spoke a bit about the acquisition and subscription phase, where Inland acquires the properties and has investors come in and subscribe. Mm-hmm. Phase 2 is, like you said, where you're earning that monthly distribution each month. Mm-hmm. I think it's really important for your listeners to understand that when the IRS approved the DST as a 1031 exchange investment vehicle, as one of the only, really the only passive investment structure that investors can 1031 exchange it and out of, back in 2004, they did instill specific rules that sponsors like our company need to follow in order to be able to offer DSTs. Mm-hmm. These are not like every other real estate strategy that you've heard of. Mm-hmm. And the way it should be looked at is you truly own a fractional interest in the underlying real estate within that DST program. So
can you just explain a little more about DST before we go there, just kind of the difference of how a DST dovetails into a 1031 exchange, if you don't mind?
We told you about the 1031 exchange, right? Mm-hmm. You sell a property, you acquire a replacement property, mm-hmm. and it allows you to defer taxes. Instead of selling a property and acquiring a replacement property, you can sell a property and invest in a DST, and that allows you to also defer your capital gains taxes. Mm-hmm. So when we say a replacement property, the replacement property is the property that you're acquiring after you sold. Instead of acquiring a replacement property, you can use a DST as your replacement vehicle. Mm-hmm. So you can use the 1031 exchange to sell a property and invest in a DST. You can use the 1031 exchange to liquidate your investment in the DST and invest in another DST. Mm-hmm. You can use the 1031 exchange to liquidate your investment in a DST and then go buy another property again.
Come out of the DST structure, essentially.
Correct. So you can go from property to property, property to DST, DST to DST, and DST to property. Mm-hmm. Yep. It's another replacement investment property. And so if you are investing, Mike, $1 million into a $100 million DST program, you own 1% of the underlying properties within that program. And the reason I phrase it so specifically like that is because you are earning the income. And again, I'm speaking for the way my company operates our programs. There are other DST companies out there. But as far as when you're investing with Inland in one of our programs, you would earn a return based on the return that the properties are generating. We, like Mike said, we have our offering memorandums is what we call them. Not instead of a prospectus, it's considered an offering memorandum. And in those, for every single one of our programs, we include a 10-year pro forma to show you what the anticipated distribution will be each year for the next 10 years. With that, if we say, for example, that the investment is going to generate, based on our pro forma, a 4.25% distribution, and we exceed that in a given year, we would actually pay investors a 13th check at the end of the year to make up the difference. On the flip side, and I have to include this, Mike mentioned that his distribution got cut 50 bips. That is a risk of investing in these programs as well, because we're not paying anything other than what the properties are truly earning in income. I always like to use the example that if you were invested in a hotel deal with us, once COVID hit, you likely didn't see any distribution for at least a little while after that. That is the operational phase of the DST, which is phase 2. You're going to receive direct deposits into your account each month based on the income that the properties are generating. And then on average, every 7 to 8 years, Inland, that's our track record. That's how long we have averaged to sell the programs, which is why I always say don't invest any amount you're not comfortable being illiquid with for at least 8 to 9 years, because 7.5 is an average. And at that point, we're in phase 3, which is the dispositions phase.
Actually, before we go to phase 3, Christine, can you, how the rent coming in, or the income coming in, that's treated as ordinary income, correct?
At the end of the year, yes. Thanks, Mike. I know you asked that question. So at the end of the year, for when you're in the DST structure, we'll send you a 1099 reflecting the net rental income that the DST provided. That's rental income, which is typically taxed at ordinary rates. And then depending what your adjusted cost basis was in the property you sold, that is what your CPA will continue to track. That rolls forward with you with any exchange. Whether you're investing in a DST or buying another property yourself, you'll maintain your adjusted cost basis. And the advantage is that depreciation that we talked about earlier allows you to continue to deduct on your tax return the income that you're receiving each year.
And then going into if you kind of the next phase, which is the disposition of the asset or the transition, like what does that look like for me as the investor? Did you just get notified that like, hey, this property sold, or do you get notified it's going to sell? How does that all work?
Yes. Phase 3, the disposition phase, Mike. At that point, let's just say, and by the way, this is kind of, let's just circle back a quick moment and re-emphasize. To Mike's point earlier, this all can sound a little overwhelming if you're hearing this for the first time. Again, this is what I'm here for, my team is here for, and what your advisory team is here for as well, to lean on us as much as possible. I'd love for everybody to read our book, The Generational Wealth Code, but you don't have to memorize everything in that book in order to make this happen for yourself. You can lean on us as much as possible, and those who do find that this becomes a pretty seamless, easy, quick process and allow us to do the majority of the heavy lifting so that you don't have to feel like all of this is cumbersome or overwhelming or too much for you.
And again, I can speak to that personally. That's 100% accurate. It is. And there's work. You have to know what you're doing, and you have to make sure you are communicating. There's a lot of emails back and forth. When you start to get the properties that are offered, the DSTs, I don't know, interesting this way. I love it. I love looking through these. Renee and I would sit down and we'd look through the offering memoranda, and we'd be like, oh, this one or this one. I thought it was fun, kind of looking like, oh, cool. What are we going to buy? We're going to buy a pretty decent chunk of a really cool property. There was some that was in healthcare sector in Florida, in an area that's just exploding, and we know because we used to drive right through there going to lacrosse tournaments, and we're like, this area is exploding. This is a great area. They're building a health center. Let's be part of that. So it is actually, that part, it had some work, but that part, if you like real estate and you like investing and trying to make more money with your money, that part's fun. And once you finalize that and it's closed, I can speak to a person. It's really no work after that. I mean, literally, you look at your statements, and I encourage everybody to always be monitoring and tracking and look at your monthly statements and look at your tax forms and make sure that everything is what it's supposed to be. But other than that, the money just shows up in your bank account every month until the phase 3 that Christine is going to get to now.
Yes, that's true. That's the goal, to just provide monthly checks direct deposited into your account every month so you don't have to lift a finger. We say you can get rid of the terrible T's, the tenants, toilets, taxes, trash, and termites, and start doing things you enjoy more, like tennis, tea time, and time with family and friends. So that's the goal of these DSTs, to be really hands-off, allow us to do all the management work on your behalf, and eventually, taking you into phase 3 now, provide you with an attractive return is the goal when the properties sell down the line. What that looks like is, let's just say, Mike, you invested in that healthcare deal with us 3 years ago, and now we're in, let's just call it 2030, and we're under contract to sell the property. We would send you, and sounds like you use my dad as your advisor in that scenario. We would send you and my dad a letter letting you know, hey, we're under contract to sell this property on June 15th, 2030. Please reply and let us know if you want to do another exchange or not. If you say no, then on June 15th, we would send the proceeds back to your account, and you would pay all your capital gains taxes when your 2030 return comes due in 2031. More ideally, though, you would say, yes, I do want to do...
Christine, is that all the capital gains going back to the deferred gains from the first sale?
Correct.
Right.
Remember,
there's no step up in basis at that point if I cash out.
If at any point you recognize a liquidity event in your lifetime, you will recognize all those gains, because remember, your adjusted cost basis stays with you. And lots of investors who have owned their properties for decades, or properties have been passed down to lots of our investors for generations, they have zero cost basis. So any sale is fully taxed as a gain. So if you say no when we sell that DST for you, then there could potentially be significant amounts in capital gains taxes that you'll owe on that return.
Yeah. Okay. Thank you.
Ideally, we'll avoid that, and you'll reply and say, yes, I do want to do another 1031 exchange. And here's the qualified intermediary that I want to use. And on June 15th, 2030, we would send the proceeds back to your QI. And you would then be given 2 other options. One, you can 1031 exchange and go buy another property on your own again. Most people do not opt to do that because they get so comfortable with the passive nature that the DSTs provide. And that's the third option, is to do a 1031 exchange into another DST. As morbid as it sounds, Mike, some people laugh when I say this, others get nervous when I say this, but the goal here is swap until you drop or defer until you die, because if you do, then eventually your heirs will get a step up in cost basis as long as the ownership structure is not set up the incorrect way. Then if you continue to defer your taxes and do subsequent exchanges into subsequent DSTs, I really call it a win-win-win for everyone involved, because you get to be a passive investor during all the years of your life that you don't want to manage real estate anymore.
Yep.
You get to defer all your taxes, and then once you pass away, your heirs get that step up in cost basis, meaning they'll have a little to no capital gains taxes to ever end up having to pay on the real estate at the time of your death. What that means is, by the way, Mike, I'm not sure if your audience understands what I mean by the step up in basis. It essentially,
that'd be great if you explain that a little more. Thank you.
Yeah, so it means that, like I said before, if you've owned your property for decades or even generations, if you've been depreciating it correctly all those years, there's a high chance that you might have little to no basis at all left on that property. So if you sell for $2 million, your gain is equal to the sales price less your adjusted cost basis. So at the time of your death, what the step up in cost basis means is that when you pass away, your heirs inherit that property with a new adjusted cost basis that is equal to the value of that investment at the time of your death, leaving no gap, leaving no gain. So when
It's huge.
It is. It's an incredible benefit to be able to pass on to your heirs.
Yeah, that's with the book, right? The generational wealth code.
And
that's generational wealth. Yeah, that's how
exactly.
you. And you know the nice part about that too is I think all parents, there's a balance. We talked about this on the first episode with the family, right? Of how do you not have the kids be spoiled or have these trust funds that they're living off of? It's while you're around, they're not. You know, that's locked up in that. The money's coming to you. Yes, you could do things and give certain amounts to kids or grandkids or whatever you decide to do in your later years. But that being said, it's not until you're gone that then they get this opportunity to have this asset and the tax liability is wiped away and they get to start fresh from there. And then if they don't do anything with it, again, correct me if I'm wrong, they can just continue to reap the rewards and keep going with it from there, but albeit with a stepped up basis. Maybe they don't want to realize $2 million at that point, and even though it's not taxed, maybe they're like, hey, look, we'd rather just get the passive income, have those checks coming in monthly still, and then maybe in 5 or 10 years, they have a major life event or something, and it's a security for them to be able to know they can do that. So I hope everybody really understands that part. I appreciate you taking the time to explain it in a little more detail because it's huge.
It is. And Mike, I mentioned this on the last podcast that we recorded together, but again, coming back to the book, The Generational Wealth Code, it really, this tax benefit, the 1031 exchange to the DST, really provides invaluable benefits to heirs in the sense that, number one, lots of clients have kids who are in completely different fields or have no idea what to do with their real estate.
Yes.
Once you pass away.
Yep.
This allows you to not have to put that burden on them upon your passing. And in addition to that, if you have multiple children, it also helps you prevent them from having any issues with each other regarding what to do with your properties when you do pass away. The saddest thing we see is kids arguing at funerals over what to do with their parents' investments and their properties. And nobody wants to see that. This really allows you to give your kids the benefit of making their own decisions about what to do with their share of your properties upon your passing.
Now, how does this differ from the last two things I want to talk about here? A little bit are REITs and qualified opportunity zones. How does this differ from a REIT? When people hear this and they think, oh yeah, I'm doing that. I'm doing what you're saying. I'm just doing it differently with REITs. What is the difference between the two?
I would point out two major key distinctions. The first one is we refer to REITs as oftentimes, if not a fully blind pool, at least a partially blind pool. What that means is, and if we compare them to DSTs, which are not at all blind pools, with a DST, Mike, I might buy, let's just say, we'll say the student housing, since we're talking about student housing with you. So we might tell you, hey, Mike, we have this student housing DST available. We already own those 3 properties in that specific fund. And when you invest in that specific fund, you would earn a return solely from the return that the properties in that program are generating.
Okay.
And your investment does not change over the next 7 to 8 years. Your allocation would be in those 3 specific properties.
Yep.
When we sell the properties in 7 to 8 years from now, you would earn the return from those 3 properties as well.
Okay.
With a REIT, when we use the term blind pool or partially blind pool, what that means is you're going into a partially blind in the sense that you don't know all the properties that will be in that program during the entire whole period. We may have 30 properties in the fund today, and over the next 5 to 10 years, buy another 10 to 15. So you already made your investment knowing about those first 30 properties, but not knowing about the other 10 to 15 that we purchased along the way.
Okay.
So that's what we mean by number one, blind pool. Number two, REITs are, and I won't speak for every REIT, but they are typically perpetual in nature. They usually have exit strategies that consist of, number one, either looking to go public, or number two, holding on to the REIT indefinitely, versus the DST has an end date. The DST, I really feel like, should feel more familiar and similar to investors like your own real estate holdings do. You buy the properties, you receive the return on them, and then every 7 to 8 years with Inland, the properties are sold and you're given the option to have a liquidity event or do a subsequent exchange. And then the third piece that I'll just mention, Mike, is that with a REIT, you cannot 1031 exchange directly in and out of a REIT, but with a DST, you can.
Okay. And just for those who don't know, as we're throwing these, just to reiterate, we mentioned it earlier, but DST is Delaware Statutory Trust, and REIT is Real Estate Investment Trust. So just for clarification, if anybody's out there listening and hears the acronyms that we're throwing around. Okay. All right. Thank you for clarifying that as well. And then qualified opportunity zones. This is something I'm actually kind of excited about. We communicated in emails about it last year because in one of the other investments I'm in luxury apartments, they are coming to the end of their term on there. It's not a DST structure. It was a post-tax investment strategy, but they're coming to the end where there's going to be a sale event on a lot of these buildings. And so there's going to be some tax consequences as well. And again, not giving specific tax advice to me or anyone, but just speaking generally, what is new in the law with the One Big Beautiful Bill Act and how it affects these qualified opportunity zones, and how can people take advantage of them or utilize them from a tax planning standpoint?
Sure. So just to rewind and give your audience an understanding on what qualified opportunity zones are, and then how they compare to what it's going to look like going forward. The qualified opportunity zone legislation came into effect through the 2017 Tax Cuts and Jobs Act. It was a bipartisan legislation, and the idea was to incentivize private investors to go into underserved communities across the country and help build up those communities versus using taxpayer dollars to do so. And what they did at the time was Congress designated zones across the country that met 3 key metrics. Number 1, high levels of unemployment. Number 2, high poverty rates. And number 3, low median household incomes. And what the legislation stated was that if an investor came in and developed a property within one of those zones, which, by the way, with the 2017 Tax Cuts and Jobs Act, there ended up being 8,700 plus zones that were designated as qualified opportunity zones across the country. And if you, as an investor, bought a property and did a ground-up development or made substantial improvements to a property within one of those zones, you would be granted specific tax benefits for doing so. And the reason for the tax benefits is because the idea is that your development of that property would bring economic growth and jobs to that area and help grow that area. The benefits are that if you invest gains that you've recently recognized, so let's just take, Mike, for example, I'm going to use a really basic example. Your business. Let's say you sell your business and you end up with a $1 million gain from the sale of that business. And I do want to very distinctly clarify this. If you sell the business for $1.5 million and you recognize $1 million gain, you're only looking at the gains with qualified opportunity zones, which is different than 1031s, where you'd be looking at the full $1.5 million sale. If you take that $1 million business gain and invest it in a qualified opportunity zone within 180 days after the sale, then you're granted several tax benefits per the initial legislation. Now, a lot of these benefits have since expired and will be reinstated with the new legislation taking effect January 1 of 2027. And what those benefits will be, again, starting January 1 of 2027. So we're at a really interesting point right now, Mike, because by the time this gets released, we'll be within the window where if a client or an investor listening to this sells their business, or if you're selling any type of investment, whether that's a stock or mutual funds or collectibles, anything that would recognize a gain on your return, that can be invested into a qualified opportunity zone. And if done so within 180 days, starting January 1st of 2027, benefit number one is that you're going to be able to defer the capital gains taxes that you would have had to pay on that gain for 5 years. The second benefit is you should be able to receive a 10% step up in basis, or for better way of saying that, a 10% reduction on that tax when it does come due. And then the third benefit, which is the greatest benefit of all, is if you might, let's just say again, you sell your business September 1st of 2026, and within 180 days after that sale, you invest in a qualified opportunity zone, again, after January 1st of 2027, then you can defer the taxes on that gain till the next 5 years. Second benefit is you should be able to pay 10% less in taxes on that. And then the third benefit is if you hold that investment for at least 10 years, then whatever the investment in the qualified opportunity zone grows to after 10 years would then come out tax-free. So if your gain, like we said, is $1 million, you're deferring the tax on the million for the next 5 years. You're paying 10% less on taxes on that million when it does come due after 5 years. And the third benefit is if you hold that investment till at least 2037 or longer, because that's where your 10-year mark would hit. If that million, whatever that $1 million grows to, would then come out tax-free on the back end.
And not have to be rolled into another one at that point.
Correct.
Wow. Okay. And that's because of the changes in the One Big Beautiful Bill Act. That's what modified that last part. Am I correct?
That applies from the 2017 Tax Cuts and Jobs Act as well. It does. Okay. The One Big Beautiful Bill just makes this a perpetual legislation. Okay. The 2017 Tax Cuts and Jobs Act created this legislation with an expiration date, so lots of the benefits have expired.
Okay.
And there is obviously we don't know what they're going to do in the next 4 years. Things can change with Congress and a new president coming in, but the way that this new bill is designed is to be perpetual.
Okay, awesome. That's great. And with the qualified opportunity zones, is that something that you could do through your CPA? Can you do it on your own? Do you need to work with someone like yourself through Inland? Like, how do you get access to the qualified opportunity zones?
The zones will be announced. They have not been announced yet. So that was something else with the new bill, Mike. They're rezoning.
Oh, okay, got it.
The opportunity zones. So the 8,700 plus zones that were originally designated, those are going to be different now starting January 1st of 2027. Okay. They have not been announced yet. Once they are announced, yes, you can technically as an investor go and do this yourself. Recommend, of course, hiring an attorney to assist with the process, but you can do this on your own. But at Inland, we offer qualified opportunity zone funds because most investors, even in your case, Mike, the example we're using, even if you have $1 million gain, it takes a lot to buy a new property and do a development to that property in an area. You can't just buy and develop a residential property, by the way, for primary home use. It has to be a property that's for investment or business purposes. So for commercial use, because again, the idea is to bring economic development and growth to the communities. And most investors don't have the capital available to do that. So Inland does offer qualified opportunity zone funds to make this tax benefit and tax strategy more accessible to investors. And that could be accessed, yes, through your financial advisor as well.
Okay, awesome. Thanks for explaining. Just for a point of clarification, because if we throw in the dates around, if people got confused, and again, I've been saying this the whole time, but correct me if I'm wrong because I don't want to misstate this, but my understanding is the reason why shortly after this podcast is actually once it's released, once we're recording end of June, but it'll be released, we're within that 180-day window of January 1st, 2027, correct? That's correct. Why there's that. So I know we were saying you have to wait until January 1st, 2027, but it's because of the 180 days to identify if you realize those gains between whatever would be July 5th or 6th or whatever the 180 days is till the end of the year. If you realize those gains from that point forward, you could utilize this. But, and again, correct me if I'm wrong, if it was prior to that date, So 365 days in a year. So like the first half of the year, we'll just call it generally speaking. If you did have a realized gain event, that wouldn't be applicable. Is that true? Because you'd be outside that 180 days, or am I wrong on that?
So we're just talking about, Mike, you can sell your business in this time next year and invest the gains in a qualified opportunity zone fund the next day, or you can wait another 180 days to invest in a qualified opportunity zone fund. Yep. The legislation states that from the day you recognize the gain, you have 180 days to make the investment in that qualified opportunity zone fund. Yep. But the new legislation does not take effect until January 1st of 2027. Yep. So that's why, like you said, you need the 180 to have within 180 days prior to January 1st, 2027 to have recognized those gains so that you can take advantage of the new tax benefits.
Got it. So if you sold something in April of 2026, that's not going to qualify because it's outside the 180 days?
You could still invest in a qualified opportunity zone fund, Mike, but the old benefits would apply, which are not as favorable as the new benefits.
Understood. Okay, thanks for clarifying that. Got it. So that's really just a matter of getting the advantages that are baked into the One Big Beautiful Bill Act. That's the that's what's going to change if you do it within 180 days of January 1st, or 181 days of the case may be, because you have to be, or I should say, you have to sell realize that gain no longer period than 180 days from January 1st, really, would be, I guess, the best way to say that, to take advantage of the new implementation.
Right. Exactly.
Okay. Sorry. And I know that seems confusing, but I want to make sure for the dates that we got that clear for everybody. This has been great. My goodness, we have covered a lot of ground. I think you explain it so well, and you're so knowledgeable in this. And what's really fun about doing this is I've learned a lot of this over the years just from your dad and from talking to my advisory team and doing the work. And that's where I think podcasts are just so amazing, is condensed down to an hour and a half. We can give everybody a glimpse. And as we've said before, the book, The Generational Wealth Code, outstanding. It does a really good job. It's chapter 11 is the real estate side, which does go over everything we went over in more detail therein for people to look at and learn from that. But the biggest thing I would say to underscore here, and then I want to hear your thoughts too to finalize things, Christine. One, make sure you do your homework and research this stuff and learn about this stuff. Don't just expect someone to do it for you. Two, don't be intimidated by this. Anybody can do this. It's a game. I always say the tax situation and it's just a game. And the rule from Robert Kiyosaki, Rich Dad, Poor Dad, he who makes the rules keeps the gold. His rich dad, that was his golden rule, right? That's true. These are all laws. These are laws that were passed by our Congress over the past numerous years. I think I remember, was it from the book? 1031 exchanges are like 1921 or something like that they were implemented. I know you said over 100 years ago, but this isn't new. A lot of these concepts, it's just, and I love that you also said on that same second point of not being intimidated in this, people hear a lot of what you were talking about and they think what you mentioned earlier, which is, this is just for the rich, or these are only things the rich can take advantage of. I guess maybe that feeds into a question, and then I'll let you kind of close it from there. Are there limits on some of these? And my understanding is there are some funds that there are some limits, but some limits are pretty low in some of these other funds, right? There's some have higher entry level points and some are lower level. Is that correct?
That's right, Mike. To be clear, these strategies are only available to accredited investors. Accredited investors are defined by individuals who either have $1 million of net worth excluding your primary home, or if you file your tax return as single, you have filed $200,000 in both of the last 2 years. And if you file married filing jointly, it's $300,000 in each of the last 2 years. And to add to that, the minimums, like you asked, Mike, are $100,000 typically on our programs. So pretty low entry point to get in. And we try to make this as accessible to investors as possible so that you can take advantage of the like I said, the tax benefits that these strategies can offer you.
That's middle to upper middle class in terms of to be qualified to get into this. So, and maybe you start small. You don't have to start going all in on this, but just start to learn about it. Just realize there are other ways out there to create wealth for for you and for your family going forward. And that's what I love about speaking with all of you guys in the Vento clan, that you have that as your core mission and vision is to really help create generational wealth. So I can't thank you enough for your time, for your knowledge, expertise. I enjoy working with you through the professional side and also enjoy having the opportunity to host you and your family for this. So anything else you want to add? I'll put a link obviously to the book for the people who want to go purchase that, which I'd encourage you to do. But any other way they can get in touch with you, reach out to you if they want to learn more about Inland or the services you offer?
Yeah, absolutely, Mike. So you can access a lot of our information. You can send me an email at cconway@inland-securities.com. And then you can also speak with your financial advisor and get in touch with us that way. You can also give me a call if you want to reach me at 917-410-7725. Happy to provide additional educational material. But again, most of these strategies, you'll have to work directly with your financial advisor, and then we can work together in implementing these strategies. And yes, as Mike said, would love for everybody to read the book that we wrote, The Generational Wealth Code. It'll talk a lot about these strategies. I know my dad probably mentioned it in his podcast, but you can definitely skip over lots of chapters that you feel don't apply to you and just skip ahead to this one. And if you have any questions, that's how you can contact us.
I appreciate that. And as the beginning of the chapter on real estate says, Andrew Carnegie's quote, "More money has been made in real estate than in all industrial investments combined." So it is not new. It is people making a lot of money in real estate for a long time. So get in the game. Even if you're later in your years, you can try to get in the game. So thank you so much. Really appreciate it. Christine Vento Conway, absolute pleasure. And it's been great having this conversation with you. Thanks for sharing.
Thanks for having me, Mike.
All right.
See ya.
Take care. Bye.
Christine Vento Conway is not affiliated with Cetera Wealth Services, LLC, or any of its affiliated companies. Any opinions or information provided by Christine Vento Conway are her own and do not represent the views of Cetera Wealth Services, LLC. The views expressed during this episode are for informational purposes only and should not be considered specific advice or recommendations for any individual. Neither Cetera Wealth Services, LLC, nor any of its representatives may provide legal or tax advice. Thank you for tuning into this episode of the Doc Podcast. Be sure to visit theorthocoach.com to get access to ADA CERP recognized CE courses or to schedule a private one-on-one coaching session with me. Also, if you know of someone who would make a great guest for this show, or if you'd like to be a guest yourself, please email me at drmike@theorthocoach.com. And be sure to join the Doc community on Facebook for more great content. Thanks so much for listening, and always remember, you have been blessed with the ability to do amazing things.